Treasury management in banking and finance, asset liability management, refinancing risk, and securitization. What is asset liability management? ALM is defined as the process of decision-making to control risk of existence, stability, and growth of a system through the dynamic balances of its assets and liabilities. It is a risk management technique designed to earn an adequate return while maintaining a comfortable surplus of assets beyond liabilities. It takes into consideration interest rates, earning power, and degree of willingness to take on debt. It is also called surplus management. In banking institutions, asset and liability management is the practice of managing various risks that arise due to mismatches between the assets and liabilities of the bank. Banks face several risks, such as the risk associated with assets, interest, and currency exchange risk. Asset liability management is a tool to manage interest rate risk and liquidity risk faced by various banks, other financial services companies. Mismatch of assets and liabilities. Banks manage the risk of ALM mismatch by matching various assets and liabilities according to the maturity pattern or the matching the duration, by hedging and by securities. Increasing integrated risk is done on a full mark-to-market basis rather than accounting basis that was at the heart of the first interest rate sensitivity gap and duration calculation. There are three tools used by banks for ALM. First is the ALM information systems, second is the ALM organizations, and third is the ALM process. ALM information systems. Information is the key to the ALM process. Considering the large network of branches and the lack of an adequate system to collect information required for ALM, which analyzes information on the basis of residual maturity and behavioral pattern, it will take time for banks in the present state to get the requisite information. Measuring and managing liquidity needs are vital activities of commercial banks. By assuring a bank's ability to meet its liabilities as they become due, liquidity management can reduce the probability of an adverse situation developing. Information availability, accuracy, adequacy, and expediency.
ALM organizations. The board should have overall responsibilities and should set the limit for the liquidity, interest rate, foreign exchange, and equity price risk. The Asset Liability Committee, or also known as ALCO. ALCO, consisting of the bank senior management, including CEO, should be responsible for ensuring adherence to the limits set by the board. It is responsible for balance sheet planning from risk, return perspective, including the strategic management of interest rate and liquidity risk. The role of ALCO includes product pricing for both deposits and advances, desired maturity profile of the incremental assets and liabilities. It will have to develop a view on future direction of interest rate movements and decide on a funding mix between fixed versus floating rate funds, wholesale versus retail deposits, money market versus capital market funding, and the domestic versus foreign currency funding. It should review the results of and progress in implementation of the decisions made in the previous meetings. ALM function covers the following processes. Liquidity risk. The current and prospective risks arising when a bank is unable to meet its obligation as they come due without adversely affecting the bank's financial conditions. From an ALM perspective, the focus is on the funding liquidity risk of the bank, meaning its ability to meet its current and future cash flow obligations and collateral needs, both expected and unexpected. Interest rate risk. The risk of losses resulting from movements in interest rates and their impact on future cash flows. generally because a bank may have a disproportionate amount of fixed or variable rates instruments on either side of the balance sheet. One of the primary causes are mismatches in terms of banks' deposits and loans. Capital market risk. The risk from movements in equity and/or credit on the balance sheet. An insurer may wish to harvest either risk or fee premia. Risk is then mitigated by options, futures, derivative overlays which may incorporate tactical or strategic views. Currency risk management. The risk of losses resulting from movements in exchanges rate. To the extent that cash flows, assets, and liabilities are denominated in different currencies. Funding and capital management. As all the mechanisms to ensure the maintenance of adequate capital on a continuous basis, it is a dynamic and ongoing process considering both short and longer-term capital needs and is coordinated with banks' overall strategy and planning cycles, usually a prospective time horizon of 2 years. And the last is the profit planning and growth.
What is refinancing risk? In banking and finance, refinancing risk is the possibility that a borrower cannot refinance by borrowing to repay existing debt. To the extent that refinancing risk is limited to the risk that debt might have to be financed at higher interest rates, including changes in credit spreads. It may be considered a type of interest rate risk. However, because the inability to refinance debt and/or exceptionally large increases in government funding costs can lead to or exacerbate a debt crisis and thereby cause substantial economic losses, in addition to the purely financial effects of higher interest rates, it is often treated separately. A number of indicators can be used in management of refinancing risk. Maturity profile, short-term refinancing volume, and average term to maturity are often used as indicators in the ongoing refinancing risk management. These indicators will be published on the first banking day of each month. Securitization. Securitization refers to the conversion of illiquid assets into liquid assets. It is the process of selling of assets by the person holding them to an intermediary who in turn will break such assets into marketable securities. It is a process used by banks to create securities from loans and other income-producing assets. The securities are sold to investors. This removes the loans from banks' balance sheets and enables the banks to expand their lending faster than they would otherwise be able to do. For example, in case of housing loans, there could be a portfolio of loans with different maturities. When these loans are bundled together for the purpose of securitization, an investor could choose a securitized paper with a specific maturity period that suits his needs.
Players involved in securitization. Originator, an entity making loans to borrowers or having receivable from customers. Special purpose vehicle, the entity which buys assets from originator and packages them into security for further sale. Investment bank, a body that is responsible for conducting the documentation work. Credit rating agency, to provide value addition to security. Insurance company or underwriters, to provide cover against redemption risk to investors and or under subscription. Obligors, company that gives debt to other company as a result of borrowing. Investor, the party to whom security are sold.
Securitization process. First, selection of assets by the originator. Second, packaging of full of loans and advances assets. Third, underwriting by underwriters. Fourth, assigning or selling of assets to SPV in returns for cash. Fifth, conversion of the assets into divisible securities. Sixth, SPV sells them to investors through private stock market in return for cash. Seventh, investors receive income and return of capital from the assets over the time of the securities. Eighth, The risk of the securities owned by the investors is minimized as the securities are collateralized by assets. 9. The difference between the rate of the borrowers and the return promised to investors is the servicing fee for originator and SPV. 10. Assets to be securitized to be homogeneous in terms of underlying assets, maturity period, cash flow profile.
Category of securitization. Asset-backed securities. Those securities whose income is derived from pool of underlying assets. For example, payments from car loans, credit cards, and etc. Mortgage-backed securities. Mortgage loans are purchased from banks and assembled into pools which become securities. Credit debt obligations. There are two kinds of credit debt obligations. CBO, collateralized bond obligations, those backed by corporate bonds. CLO, collateralized loan obligations, those backed by leveraged home loans.